It is a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal, to help cut through that noise to navigate the best moves for your portfolio. And today we're looking at the buzziest topic of the year, artificial intelligence. And we're talking about how to incorporate it into your portfolio. And I'm here with Granite Shares founder and CEO Will Rind. And thank you for stopping by here today. Let's talk about the, I would call this a darling of this year's AI boom, and that's Nvidia. Tell us a little bit about why you like this stock. Up 240%, can't go wrong there.
Yeah, well, Jared, the chart, in a way, a picture tells 1,000 stories, and the story this year has been all about AI, and particularly Nvidia. And Nvidia has really captured that zeitgeist for any investor that's looking to get exposure to AI. Now, if you think about AI as a theme, Nvidia is a company that provides the picks and shovels, so to speak, to allow companies to thrive in this particular space. The performance has been phenomenal.
All right, now let's get to some of your reasons here. First, we've got to look at earnings. This is a solid company, but tell us what you like in the fundamentals.
Yeah, so the earnings have been really, when you get hype like AI, it's about, can a company live up to that hype? And Nvidia has been a company that has lived up to that hype this year. Q1, Q2, and Q3 earnings all beat expectations, and we have practically every analyst on the street expecting the company to continue to deliver.
Practically, but not quite all of them. I believe there are, 31 buys and a couple holds there as well. What do you think about the analyst reaction to this stock?
I think so far it's been pretty phenomenal. I mean, when you get that sort of larger spectrum, like you said, almost everybody's a buy. I think you have 3 holds, 0 sells, and the average price target significantly above where we trade today. That tells you that across the street, I think the view uniformly is bullish on the stock.
All right, and I think I described it as a darling, but also the poster child of AI here. We've seen a lot of the gains tied to Nvidia performance. Tell us about this phenomenon.
Yeah, so in terms of Nvidia, I think the AI phenomenon has been what has caught investors' imagination. But this is a company that, remember, was very famous for delivering in the gaming sector, particularly when people were very excited about the metaverse. And so it was a company that, revenue stream-wise, is diversified among its data center business, the gaming business, and of course the GPUs, most famously, that are powering the chat GPTs and things of the world.
All right, want to pour a little bit of cold water on here. Not everything's perfect. What does the stock have going against it right now?
I think the biggest risk to Nvidia is China, its relationship with China, because there is some political risk that has come into this with the export controls on advanced technologies from the United States to China, of which Nvidia gets caught up because of chips particularly. So there is some risk here. At the moment, the company has a workaround to that, but we'll see obviously how that goes going forward. But the biggest risk is this political element.
Yeah, and let me just stick on this for just 2 seconds, because I've watched how the export controls or whatever the specifications come out. Nvidia crosses a few wires and magically they're able to ship a new product in a number of months here to get around them. Can that continue, do you think?
I think this is a company that you don't want to bet against. Who knows in terms of the future, how they'll be able to continue. But I think that what they've shown is it's a company that has continued to reinvent itself in different circumstances. And as of right now, despite the export controls, the company is keeping up with expectations. All
right, don't bet against Nvidia, but we got to talk about another ticker here. And if you like AI, guess what? They got the ticker. It is AI. C3 AI is a company relatively small there. I was looking at their revenue. It's only $250 million per year. What don't you like about this particular stock, which is up 140 or 188% this year?
So again, it's been up, incredible performance this year on a standalone basis, but we're not talking about this year. We're talking about next year. We're talking about the future. With C3 AI, as you said, Jared, the clue is in the name. Got a lot of retail investors excited because it had AI in the name. A lot of people piled into the stock and drove the stock price up. Now, unlike Nvidia, when we talk about hype and companies living up to the hype, this company has not lived up to the hype so far. And I think going forward, it's going to be more challenging.
All right, well, that's not the only reason that you have revenue guidance. That came in a little bit weak. I believe they held it, but what don't you like about the company's prospects from their own perspective?
On the revenue perspective, sales are slowing down. Again, this is a company that has a large portion of its revenue tied to a contract with one particular company, as Baker Hughes in the energy space. That deal is supposed to expire in 2025. No signs, clear signs at the moment that's going to review. So perhaps some uncertainty around the future revenue. But I think in terms of the portfolio of apps, starting to see that weaker sales growth, and of course still a company that's not profitable.
All right, one more reason ticking down these. I said it was up, 188% this year, a little bit overvalued?
Yeah, and I think again, if we look back to what we were talking about with Nvidia, this time we look at the analysts that cover this particular stock, there isn't really any clear bullish sentiment. Sells, there are some buys, holds, but it's pretty evenly distributed. So I think it shows you that the collective, or at least the average, price going forward is actually below where we trade today, unlike Nvidia, which was higher. So forecast for next year, below where we trade today. Sales slowing down, a company that hasn't managed to really grow into that hype of AI that was expected at the beginning of the year.
All right, well, every dog has the ability to shake off its fleas every now and again. What can C3 AI do to turn it around?
I think, put simply, has to be able to live up to the hype, to the expectations. And ultimately, when it comes to stocks, you have to take more than just the theme, the AI hysteria itself. We've got to see that coming through in the earnings. And so, irrespective of what the analyst forecasts say, the company now has to deliver on earnings for that to fulfill its expectations.
All right, interesting stock there. And I should note, it's actually still 83% down from its record high several years ago. But just to recap here, your buy is Nvidia, and let's round this out. We have Nvidia there. Company had strong third quarter earnings results. Wall Street is bullish with 31 out of 34 analysts rating it a buy. And you see Nvidia as a poster child, say that it is a poster child for AI exposure. And on the flip side, we have C3 AI. It hasn't fully leveraged the AI boom. It gave weak revenue guidance, and it is overvalued. Will, thank you for stopping by here today.
Thank you, Jared.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're looking at the buzziest topic of the year, artificial intelligence. We'll discuss how to play the space with one sure bet today and one that maybe has some promise down the line, but maybe not quite yet. I'm here with Defiance ETF CEO and CIO Sylvia Jablonski. Sylvia, great to see you in this capacity. Welcome to Goodbye or Goodbye. I feel like it's a game show when I say it like that. But obviously we're talking about some good ideas here for investors. So let's talk about first your Goodbye, and that is Alphabet within AI here. Let's go through your investment case. Obviously, looking at the past year of chart, it has already done quite well. But it's still, according to your first point here, cheaper than the other Mag 7 stocks.
Yes, and great to be here. This is a lot of fun. So I love Alphabet. I think it is actually one of the cheapest Mag 7 stocks now. So it's trading at a multiple of about 25 versus an average of 41. And they're touching so many different areas. So when you think of Google and what they're going to do, you have YouTube, you have Android, you have ad sales, you have generative AI with the Gemini announcement recently, and also quantum computing. So they touch a lot of awesome spots. So you have Gemini AI revenue potential up there. So we know that Microsoft kind of came blazing, all forces go, and they kind of won the race this year for 2023. I think that arguably Google is going to catch up next year and sort of take over. And because they lead in ad sales, they can use their generative AI bots to help with customer service, to help craft better ads, and essentially capture their already existing audience and generate revenue potential from AI.
Yeah, I think that's a really interesting point about all of the different areas and lines of business that Alphabet touches where this could be an effect. And we're talking about a big market. I mean, all of the estimates that are out there are very lofty in terms of how big AI is going to be.
Yes, and so if we think about AI having a CAGR of 20% or so for the next 5 to 10 years.
Compound annual growth rate.
Compound annual
for those
growth
who don't
rate,
know.
yes, in the next 5 to 10 years. that's a massive opportunity. But actually the $2 trillion that I refer to here is for the cloud business. So they had 23% year-over-year growth in cloud. They're behind Amazon and Microsoft, but they're certainly catching up. And if you think about all of this, with all of the data and storage, we often talk about AI, and it's just kind of like this one word that we all focus on, but you need supercomputers, you need quantum computers, you need cloud services, you need cybersecurity. And so Google, again, plays in that space. And I think the cloud playing in that $2 trillion will help the company grow.
Yeah, that's something we were just talking about with the semiconductor analyst, actually, all of the training power and chips, and that then speaks to the cloud also, that's going to be necessary to power all of that activity.
Exactly.
All right, let's talk about a potential risk, though, for Alphabet and to the upside for the stock. Or actually, you've listed a couple of them for us here. And that one of them is that Gemini doesn't work out how they want.
Yeah, and these debuts have been super interesting because some of them are shock and awe, and then all of a sudden you go back and kind of review how they set the AI tool to work and respond to the particular question. It's like, it leaves you wanting a little bit more. But yeah, any of these AI bots or generative AI technologies could actually fail. If they do fail, that's, and they kind of fall below Microsoft again and fall below Amazon again and whoever it might be, that's an overhang. Macro, just uncertainty. I don't necessarily think this is going to happen, but if we're worried about a recession, if we're worried about any change in the inflation game here, then companies spend less, essentially. But 70% of the S&P 500 companies apparently are already using some of Google's cloud services. So if they can capture that group for AI, that's a great opportunity too. And yeah, the less business spending would go with the macro overhang.
Yeah, it would be difficult to see though if you already have cloud spending pulling back.
Yeah.
If you're using that capacity, I guess, unless your clients don't need it or something along those lines. Before we move on to your goodbye, do you hold Alphabet?
I do hold Alphabet.
Okay, so
yes.
you have a position in Alphabet. Now let's get to your goodbye, what you're saying farewell to. And this one is Adobe, which is an interesting one for multiple reasons, not least of which is that it canceled a big acquisition this week. But we'll get to that. First of all, the company recently came out with an outlook, and you and many other folks found it underwhelming.
Yeah, so in their last earnings announcement was actually really good. They were up kind of 10 to 12% in different categories year over year in their services. They're arguably one of the leaders in creative software technology, but their outlook was sort of left a lot to be desired. I think they came in at about $21.33 billion. The street was expecting about $21.73 billion. And they haven't really monetized AI to the extent that they're talking about AI. So, we sort of want to see a little more growth, I think. And by the way, I'm not sort of like picking on this stock because that last chart that you showed is phenomenal, right?
Yeah.
This is like it's not like goodbye because you're terrible. It's like goodbye, take your gains, right? And put them somewhere else. So it's,
I like that, a different spin on goodbye.
Yes.
Well, let's talk about another catalyst that happened for the stock is that the company canceled its acquisition of Figma. Now, you could argue strategically there's fallout. There's also the fact that it's going to have to pay $1 billion breakup fee for that, or canceled merger fee.
Yes, so there's two ways to look at this. One, they free up that that money, that $20 billion, but they lost $400 million of potential revenue. They have to pay that $1 billion fee, and I think that they're just and they also wanted to kind of take over to wipe out one of their competitors, right? So I just think that there's going to be some noise with that $1 billion fee. I think that they're going to have to sort of shake things out and refocus what their plan is to fully develop their AI technology because of this. And so 2024, I think, is going to be a shakeout year for them. And then I think 25, 26 going forward, growth potentially continues. But near term, I think they've kind of hit their peak. And valuation wise, we're talking about 52 versus Google's.
Gotcha.
25.
All right, and there's one more thing you're watching, and that's what insiders are doing. And there's a chart that you brought us that shows the insider sales. We've seen the likes of CEO Shantanu Narayan, who's been among the folks who's been selling shares.
Yeah, and so there's two ways to look at this too, right? So I think a lot of times insiders sell because the stock price is really high, right? And they're trying to generate their own profits and income and things like that. But if you kind of look at this graph here, there's just been like a consistent level of selling through the last year or so. And I just think that oftentimes insiders, they're closest to the business and they kind of know something. So I do think that maybe the lack of confidence from insiders is telling of a potential thing to look at anyway.
Well, something to be aware of, certainly, when we look at that. And then what would be the risk? What could end up going well for them in 2024?
Yeah, so I think, I think that they are the leader in creative software. So I think if they don't have any issues with the FTC about subscriptions, they have these super expensive subscriptions, they have a captive audience. And so then if they roll out the generative AI, I do think that they can expand on the revenues they already have. They can take that $20 billion and put it into Firefly. They can put it into trying to capture a larger audience. They're going to have to kind of fight against Microsoft Paint, which is now going to be another generative AI software. So but overall, look, their margins are good. Their balance sheet is good. It's a well-run company. It's hard to argue that they're going to fall off of a cliff here.
And do you have any position in Adobe?
I do not.
Okay. All right, Sylvia, let's sum up what you have told us today. So your buy's Alphabet, you're bullish because it's cheaper than the other Magnificent Seven stocks, and you see AI revenue potential from Gemini and projected growth at $2 trillion in the next decade, particularly when we're looking at the cloud engine for Alphabet. And your good buy is Adobe, at least in the near term. You do see some headwinds in 2024, an underwhelming outlook, a $1 billion payment to Figma because the merger did not go through, and you're seeing insiders sell the stock. So that's to sum up. Sylvia Jablonski, thanks so much.
Thank you for having me.
Really appreciate it. That does it for Goodbye or Goodbye. We're going to be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. We'll be right back. It is a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today's focus, the banks. After the chaos caused by the collapse of Silicon Valley and other regional banks in the first part of the year, regional bank stocks collectively have recouped those losses. The conventional wisdom was that the big banks would be better positioned following that crisis. Today's guest is turning that on its head. I'm here with Bob Elliott, CEO and CIO of Unlimited. Thanks so much for being here,
Thanks
Bob.
for having me.
So you actually like a regional bank stock, and you have a mega cap bank stock that you don't like. So let's get to the regional bank stock. It is Comerica. And this is a regional that did get caught up. We can certainly see it on the chart. It got caught up in what was going on with SVB earlier in the year, had deposit outflows like many of its peers. So you're looking at it now for a number of reasons. One of them is, on a relative basis, you like the valuation of Comerica.
Well, I like the valuation a lot. You've got one of the regional banks that's trading, at a 6 PE, which is one of the lowest PEs amongst the regional banks. And the stock is still down, 20 or 30% from pre-SVB conditions, when you're seeing a real stabilization in the overall economics of the business. So it's not clear that decline in the stock price makes a lot of sense, particularly in the context of some of the buoyancy we've seen in other stocks, which of course we'll get to later.
And again, collectively they've recovered, but Comerica, to your point, hasn't. Why has it been punished so much more than some of the others?
Well, I think one of the challenges is some of these smaller regional banks are in a difficult position to absorb a lot of this incremental cost around new regulatory frameworks and things like that. That is something that's hindered the stock operating as an independent, but given where it's positioned and where it is relative to all these other sort of smaller regionals, it actually may be a good opportunity for an acquisition from one of the bigger ones, particularly when we talk about its geography and its footprint and its growth into Texas and California, high growth markets.
All right, put a pin in that. We're going to talk more about that in a minute. Let's talk about some of the other fundamentals of the business. Effectively, you're seeing it as having a lower risk balance sheet versus the rivals. And one of the things I was intrigued by that you brought us is its non-interest bearing deposit accounts as a percentage of the total and how it compares to the other bank. This is Comerica on the right here. We've got the likes of Zions Bank and some of the others going all the way down. WBS, I don't know. Huntington, I know HBAN, that one.
Exactly.
In any case, these are deposits that they don't have to pay interest on.
Right. I mean, the sort of sweet spot of any smaller bank is traditional business transactions and customer deposits, people who are getting their paycheck deposited, businesses that are, small businesses that are running their day-to-day operations. Those are non-interest bearing deposits, and the more that those banks have, the less that they have to pay on their deposit base. And so you look across, the range of different banks, and you see Comerica is actually very well positioned, even though on the margin, the non-interest bearing deposit, the interest bearing deposits deposits are a little bit higher. When you've got, almost half of your deposit base paying zero, you got a lot of good sticky deposits that are there based on a relationship reason rather than, looking for the highest yield that's out there in the market.
Right, and they're low cost to you, obviously, as the bank. And then finally, there's the other point you mentioned, that it's growing in places like Texas and California.
Yeah, Comerica actually is my hometown bank. I'm from Detroit. I grew up in Comerica with accounts there, but in the time since I've left Detroit, it's moved its location, its headquarters to Texas, really banking the Texas boom that we're seeing that's going on. And the other thing that I think is interesting is it made inroads in California. It was actually pretty conservative in the California market relative to some banks that we've been a little more familiar with lately. And that's actually positioned it well. It's got, for instance, one of the oldest venture lending businesses in the country. And it's stepping in where SVB and others are stepping out. And so it's really positioned to take advantage of the weakness in some of the other banks that are in the space.
So given all of that, what do you think is the biggest risk here? It's that maybe we see another hit to these small banks?
Well, I think it all comes down to whether we see a broad-based bank run. Now, I don't think that that's going to happen. And the Fed's made it pretty clear that they're going to do what it takes to ensure that the deposit base remains stable. And what you're seeing actually is deposits have grown since the SVB situation for most of the regional banks, even though they're still declining for the big banks. So it doesn't look like we're going to be in that situation, but of course that's always a risk that's out there for these.
And just quickly, before we move on to your goodbye, you hold Comerica?
I don't personally in my accounts or my business.
But it's one that you like. Okay, and then let's get to your goodbye, one that you would avoid. And this is a big bank. We're talking about Bank of America. So it's not as though automatically in your mind, bigger is better in terms of what people should be buying. Here too, we start with valuation.
Well, you got to think about it. You got two stocks that both were very exposed to the consequences of the SVB crisis. Bank of America, in particular, with a large securities portfolio that they've got to be booking in order to take the capital charges as a GSIB. And so they're facing challenges as a function of that, similar challenges that happened in the regionals. It's just that they're priced about twice as high as what you're seeing in some of the low valuation regional banks that are out there like Comerica. And so when I look at this diff here, we've got essentially the best of the small and the worst of the big.
Got it. Okay. And then also on that front, you're looking at net interest margin from Bank of America compared with that of a Comerica, and you say it does not favorably compare.
Yeah, Bank of America, given it's a GSIB, should be killing it in terms of their overall deposit costs, but you're seeing that average deposit costs start to move up into the 2 range. That's a lot, given there's so much incentive for big businesses to bank with Bank of America and their national footprint. So that's causing them to see a NIM compression that is, actually not that far off of what you're seeing from many of the regional banks. And I thought this was a nice, interesting contrast that Bank of America, is at 240, Comerica's at 260. You wouldn't necessarily have thought that right off the bat.
Right. And then finally, whereas Comerica is expanding, you're talking about that the business here is not growing. And in particular, you wanted to highlight what we're seeing in loans and leases, which if you look at this over the past few quarters, hasn't gone much of anywhere.
The whole advantage of being a GSIB is that you should be able to outcompete all of the different regional competitors that are out there. There's a number of other big banks here in New York who have taken advantage of the weakness that has existed through organic growth as well as acquisitions. Bank of America, it's been a flat business for several years now. We look here in terms of the loan book, the wealth management, cards, they're lagging behind many of the other issuers. This is not a great franchise. It's a big franchise, but it's a lumbering, slow-moving one that looks expensive relative to some of the other options that are out there.
And effectively, the risk to your thesis is sort of the flip side of what we saw. If there is a crisis, money might flow into the banks. I want to get to our summary here of your buy and sell case. And by the way, any position in Bank of America Okay. So to recap, you are saying to investors you could buy Comerica based on its value against other regionals of a similar size and better balance sheet, plus its potential for further growth as it expands operations, filling the gap that was left behind by the collapse of SVB and others. On the other side, you say maybe you want to avoid Bank of America, high valuations, stagnating net interest margins, despite being such a big player.
They command multi-billion-dollar empires and dominate the boardroom.
I admit when I'm wrong.
What you want to do is control your controllables.
Decisions that impact your investments are made by them every single day.
Profit and purpose go hand in hand.
Now, Yahoo Finance grants you exclusive access to these titans of industry. Discover the motivations behind industry-altering decisions and the visionaries who imprint their legacy on the world's most renowned companies. Join us for our groundbreaking series, Lead This Way.